Hi everyone, welcome to our Project 2 presentation with myself, Alex Georgievich, and my group mates Caitlin Osman and Christina Sperry. Just to give a brief overview of today's presentation, I will be discussing our historical return data, as well as our expected returns and risk for our asset classes. Christina Sperry will provide a thorough review of all investment options considered, as well as our REIT recommendation. Caitlin Osman will discuss the pros and cons of a real estate allocation for Miss Wildcat and provide our recommendation of an appropriate level of real estate as well as the placement of the investment. And I will wrap up with our concluding thoughts. All return data is for a 10-year sample of historical returns from January 2015 through December 2024. For Ibbotson large cap stocks, annual expected return came out to around 15%. This seemed a bit high to us, and further research from Investopedia shows that the S&P 500 has delivered an average annual return of around 10.13% since 1957. Research from Advisor Perspectives confirmed our suspicions that stocks appear to be overvalued right now, so we do expect a drop in returns to around the historical return of 10%. We felt comfortable with the standard deviation of 15.4% for stocks, as that was in line with what we expected and confirmed by additional research from Guggenheim Partners. For bonds, we pulled historical returns for Ibbotson intermediate government bonds, and the expected return came in a bit low at 1.14%. Further research indicated that this was largely due to the Fed raising interest rates 11 times between March 2022 and July 2023, having a downward effect on bond returns. Using the rate of return on everything document, as well as additional outside research, we felt 3.75% return was more in line, yet also a more conservative estimate due to stubborn inflation and economic uncertainty, which could cause slower interest rate cuts or potential for rate hikes in the future. We were comfortable with the standard deviation for bonds, as that was in line with our expectations and within range with research from Morningstar as well. Looking at REITs using the NA REIT data for return for all REITs, ICR analysts expect 9.5% returns in 2025 and 10% in the long term. However, given the mentioned economic uncertainty, we did slightly adjust our expected return for REITs downward. As for standard deviation, we calculated around 18%. We felt as though this may be a bit high, and our research has shown that equity REITs have a lower standard deviation of 11.4% over the past 25 years. However, given that our calculation was for all REITs, we proceeded with this number.
Before discussing the potential impact of real estate investment trusts on Miss Wildcat's portfolio, we will first examine the different types of REITs under consideration and their respective advantages and challenges. Our analysis includes a mix of non-traded and publicly traded REITs, each with distinct structural differences that affect risk, liquidity, and overall portfolio performance. Non-traded REITs typically offer reduced market volatility since they are not subject to daily price fluctuations, but they come with higher expense ratios and lower liquidity, meaning they may have restrictions on withdrawals. Publicly traded REITs, on the other hand, provide greater liquidity and lower costs, but are more correlated with stock market movements, making them more volatile in the short term. Given these structural differences, comparing REITs requires a multi-factor approach. To ensure an objective evaluation, we analyzed the 5-year average returns to assess historical performance, liquidity considerations, including ease of buying and selling shares, expense ratios, which impact overall investment costs, sector focus, evaluating whether the fund primarily invests in residential, industrial, retail, or diversified real estate, geographic exposure, assessing whether the REIT is concentrated in a specific region or has a broad diversified footprint. By comparing these metrics, we can determine which REIT best aligns with Miss Wildcat's investment goals, considering both long-term stability and return potential. Some of the REITs that stood out specifically were the Blackstone REIT Fund, which had returns of 8.95% over 5 years, is a broad mix of geography and property sector. The Blackstone REIT's geographic exposure is chiefly in the southern and western U.S. The Clarion Partners REIT had returns of 9.07% over 5 years. Like the Blackstone REIT, it is a non-traded fund, meaning that it has higher expense ratios and lower liquidity. This fund's geographic exposure is very diverse, with investments all over the country. The third standout was the Vanguard Real Estate EFT, ticker VNQ. While this fund has a lower 5-year average return of 3.05%, because it is publicly traded, it offers higher liquidity and lower expenses. Which of these funds is the best choice will still depend on further analysis of Ms. Wildcat's portfolio.
Ms. Wildcat currently has an aggressive portfolio made up of 22% bonds and 78% stocks. When we added REITs and looked at what that would do to the efficient frontier, we found that there was no change. Based on this information alone, we would have recommended that Ms. Wildcat not add REITs to her portfolio. However, because this is a goal of hers, we dug deeper and saw that the reason REITs weren't being added to the portfolio was because across all REITs, there's a fairly high standard deviation for a relatively low return on investment compared to her current portfolio options. We decided to take this a step further and look at specific REITs that might be more appropriate for Ms. Wildcat's portfolio.
After considering how important the level of risk is for influencing Ms. Wildcat's portfolio, we have made the decision to recommend an investment in Clarion Partners Real Estate Investment Fund. With a strong balance of risk-adjusted returns, sector and geographic diversification, and cost efficiency, as well as a very important lower than industry average standard deviation of 1.94, we feel this investment would be a strong choice for Ms. Wildcat to increase diversification while maintaining risk stability. CPREX has demonstrated consistent performance with competitive 5-year average return, making it a reliable choice for a long-term portfolio strategy. Stability. The fund's geographic diversification spans multiple regions, reducing regional market risk, while its sector allocation balances exposure across residential, commercial, and industrial real estate, mitigating concentration risk. Additionally, CPREX maintains a controlled expense ratio, ensuring that investor returns are not significantly eroded by high management fees. Its lower debt-to-equity ratio also signals conservative leverage, reducing financial risk and enhancing portfolio resilience in fluctuating market conditions.
With the addition of CPREX to Ms. Wildcat's portfolio, we do see a significant shift in the efficient frontier. With a weighting of about 40% of CPREX to stocks, we see that for a similar target return of her current portfolio, there is roughly half a percentage point reduction in risk. Ms. Wildcat's current portfolio is held in an individual taxable account, a rollover IRA, and a Roth IRA. Based on her high income, she's no longer eligible to contribute to the Roth IRA, and because it only holds 1% of her current holdings, it doesn't make sense to try to include the 43% holding in REIT in the Roth IRA. For her individual taxable account, it would qualify her for long-term capital gains tax on the sale of the REITs after she's held on to them for 1 year. However, any income generated by those REITs while they are held in her account would be taxed. This may not be the best option because of the amount of dividends and income that are generated from REITs. The best option for Ms. Wildcat is to convert all of her holdings in her rollover IRA to CPREX. That way the income generated is not taxed, and she will have that capital gains tax when she goes to sell those REITs. Because only 37% of her portfolio is in the rollover IRA, then we would recommend that she add the other 6% into her taxable account.
So to conclude, we feel that CPREX would be a solid addition for Ms. Wildcat, given her investment goals and the strong balance of risk-adjusted returns. As noted, it has a controlled expense ratio to keep management fees in check, and the fund has a diverse geographic exposure with investments throughout the nation. And lastly, given the tax benefits, our recommended option is to convert the current holdings in her rollover IRA to our recommended REIT. Thank you, and we look forward to your questions and comments.